Hello everyone, warm welcome to Super Coaching by Testbook YouTube channel, where we are going to discuss very important questions based on finance. As you know, we have started with a series, and in this series every day at 7 p.m. Monday to Saturday we are discussing the most important MCQs based on your upcoming Phase 2 examination. So if you're preparing for RBI Grade B 2024 Phase 2 examination, which is going to be held on 19th of October, this 7 p.m. session is must to attend for everyone. So without any further delay, let's get started with the discussion. But before I start the discussion, I would request everyone quickly copy the link of this session, share it with your friends so that more and more students can join us live. I'm also doing the same, so let's collectively share the link of this session. You also share it with your friends so that everyone should know that yes, this session is live. So let's get started, guys, without any further delay. I have a first question on the screen. The first question talks about which of the following statement is or are correct with respect to capital adequacy ratio. We all know that capital adequacy ratio is a term which was introduced by BCBS, that is Basel Committee for Banking Supervision, under Basel I. And in Basel I, they have targeted a risk which is termed as credit risk. And in order to mitigate the credit risk, BCBS asked its member banks, that is the central banks, that you should ask your regulated entities to maintain a ratio that is known as capital to risk-weighted asset ratio. So capital to risk-weighted asset ratio, we also call it as CRAR. What is capital to risk-weighted asset ratio, or what is capital adequacy ratio? It is basically the ratio of bank's capital against the bank's risk-weighted asset, and it should be maintained at least 8% according to Basel I norm when it was introduced. Now let's check out the questions on the same. The first question, the first option we have, it is also known as capital adequacy ratio. That is true. Indian scheduled bank, see, according to BIS, it is need to be maintained at 8%. That is true. But RBI asked Indian banks to maintain 1% extra, that is 9%. That is also true. Basel III norm stimulated a capital to risk-weighted asset of 8%. That is true in Basel I, Basel II, Basel III. In all the three norms, this percentage has been maintained the same, that is 8% only. So answer is going to be D option. 1, 2 and 3 are the correct answer. Moving on to the next question. What does the next question say? Which of the following statement is or are correct with respect to the risk-weighted asset? What is risk-weighted asset? See, if I'm talking about a bank, so bank provides loan to the public, and the lending done by the bank is termed as bank's financial asset. Why I'm saying that the loan given by bank is termed as bank's asset? What is the reason? So reason is very clear. The loan given by the bank will fetch returns to the bank in the near future, because of which we call it as an asset. Now, obviously the financial asset, that means the loan given by the bank, it is prone to risk. Risk, what type of risk I'm talking about? I'm talking about credit risk. For example, if you're borrowing the loan today, and you are not paying back the loan to the bank, that is going to be a situation of risk on the bank. Now, if I say what is risk-weighted assets, so risk-weighted asset means the risk of the bank, the risk on the bank's each and every asset. Now, for example, bank has its asset in the form of cash. Bank may have its assets in the form of government securities. Bank may have its asset in the form of loan. Bank may have its asset in the form of interbank deposits. So all these assets, when we calculate the risk on each and every asset, that is basically termed as, or the sum of risk on each and every bank's asset is known as risk-weighted asset. So sum of risk on each and every asset of the bank, so total risk on the entire asset of the bank is termed as risk-weighted asset. So let's read out the first option. It is bank's asset or off-balance sheet exposure weighted according to the risk. That is true. Weighted according to the risk, that means you are adding the risk on each and every asset that is known as risk-weighted asset. It is absolutely correct. It is used to determine capital threshold risk factors. It is used to determine capital threshold risk factors. What does it mean? Any idea, guys? Have you heard this term earlier? Have you heard this term earlier? It's a new term over here, and I'm not sure that I'm pretty sure that many of you are not aware of this particular point. So please check it and give me the answer in the comment section, please. What is the meaning that it is used to determine capital threshold risk? What will be the answer? So it is used to determine the minimum amount of regulatory capital that must be maintained by the bank. In that context, it is true. The riskier the asset, higher the RWA and greater the amount of regulatory capital required. That is also true. So more risk is associated with your asset. Obviously, more capital reserves are required to back that risk. So first statement, third statement are correct. What is second statement? It says that it is used to determine what capital you need to hold in order to mitigate this risk. So that is also true. So according to that point, 1, 2 and 3, which means D option is absolutely the correct answer. Moving on to the next question. The third question of the evening says, which of the following ensures that banks have an additional layer of usable capital that can be drawn down when losses are incurred? So the question is, which of the following ensure that banks have additional layer of usable capital that can be drawn down when losses are incurred? See, capital adequacy ratio, it is not an additional. It is not an additional reserve. It is the primary reserve which is maintained not only to counter the credit risk but the other risk on the banks as well. But over the period of time, as the risk exposure on the banks has increased, then in Basel III norms, along with capital adequacy ratio, they have introduced, BCBS have introduced capital conservation buffer, which every bank is need to maintain, which is 2.5% of RWA. And when banks are doing well during their normal days, during their good days, they need to maintain the counter cyclical buffer in a range of 0 to 2.5% of RWA again. So if I talk about the additional layer, in that case, additional layer is going to be CCB. So answer is going to be capital conservation buffer. In India, all the banks which are regulated under RBI, they are maintaining capital conservation ratio as well as they are maintaining CAR. And now banks are maintaining counter cyclical conservation buffer during their normal days. Is it clear? Moving on to the next question. Here we go to the next question. Which of the following NBFCs are not covered under prompt corrective action? This is a very important question. I would say it's really very important question. Why? The reason is recently there has been an update on the same. And what is the update given on the same? Question can be asked for sure on this particular point, because recently there was an update given related to PCA and NBFCs. Related to PCA on NBFCs. So what is the latest update? If I talk about the latest update, it says that now PCA, when it was introduced, it was introduced only on all deposit taking NBFCs, as well as it was introduced on some criterias. But recently, Reserve Bank has decided that prompt corrective action framework for NBFCs will be applicable on government NBFCs as well. So from 1st October 2024, PCA framework is now applicable on government-owned NBFCs as well. Except those NBFCs which are in base layer. those NBFCs which are in base layer. So this is the latest addition which you need to remember, which you need to include in your information. So objective of PCA is very much clear, but the question is, so this will be applicable on the basis of 31st March 2024 data. So on the records of 31st March 2024 data, from 1st October 2024, PCA is now applicable on government owned NBFCs as well, earlier which was not applicable, but excluding those NBFCs which are included, under which, so which are included under the base layer, Is it clear? Okay. So all deposit taking NBFCs are not covered. Is it true? No, sir. NBFC is not accepting public deposits. That is true. Housing finance companies, that is true. So answer is going to be E option, that is B and C. So PCA does not apply to NBFCs not accepting public funds, government companies deposit taking or non-deposit taking, but now this has been updated. As I mentioned, from 1st October 2024, PCA is going to be applicable on government owned NBFCs as well, but what is excluded? Only the base layer NBFCs are excluded. Done, clear. Okay, moving on to the next question. As per the risk threshold 1, PCA on NBFC will be imposed if the net non-performing asset is between. So this is a very important question. I think I will be able to give my entire answer on the screen itself. So please pay attention, guys. This is going to be interesting. We know that very well. Under PCA, we have three risk threshold conditions. First, we call it as risk threshold 1, then risk threshold 2, and risk threshold 3. So I write it as risk threshold 1, risk threshold 2, and risk threshold 3. First, it is on the basis of tier 1 capital. First is on the basis of tier 1 capital. Second, we have is additional tier 1 capital. And the third one we have is, that is net NPA. So if I talk about the question, then triggering point. What is the triggering point? So triggering point is up to 6%, which means if net NPA increases above 6%, then that NBFC will be included under PCA. It will remain in the threshold category 1 if NPA is in a range of 6 to 9, 9 to 12 in threshold 2, and if net NPA is greater than 12%, then it will be included under the category of, risk threshold 3. It will be included under the category of risk threshold 3. Please check it once. Is it clear? Now, you must be wondering, sir, will you answer the threshold conditions? For above two factors as well? For sure, guys, I'll answer them. But first, I want you to just give a look. Now, if I talk about the triggering point, in case of tier 1 capital, your minimum capital should be 15%. Now, if capital is below 15%, that means if it is in a range of 12 to 15%, risk threshold 1. If it is below 12%, that is 9 to 12%, risk threshold 3. And if it is less than 9%, then I would say it is risk threshold 3. What is the triggering wala part? So triggering wala part is, it should be minimum 15%. In case of additional tier 1, it should be minimum 10%. If it falls below 10%, but in a range of 8 to 10%, tier 1, 6 to 8%, tier 2, or I would say risk threshold 2. And if it is below 6% for additional tier 1 capital, then it will be risk threshold 3. So answer to the given question, in case of net NPA, triggering point is minimum 6%, and if it is above 6%, it will trigger, and it will in the first risk category for 6 to 9%. For 9 to 12%, it is risk threshold 2, and above 12%, it is risk threshold 3. So answer is going to be A option. Clear, guys? Got it? Just give me yes, sir, in the comment section. Chalo. I hope the answer is correct. Hanji, sir. Moving on to the next question. The next question says, consider the following statement. Consider the following statement. 1 second. Fine. Consider the following statement about NARCL, National Asset Reconstruction Company Limited. It has been incorporated under Companies Act 1956 or 2013. That is true, but along with that, as it is an ARC, it is under SARFAESI Act, Security and Reconstruction of Financial Asset and Enforcement of Security Interest Act 2002, Section 3. Public sector bank will maintain at least 51% ownership. That is true. It is intended, when it was set up, it was intended to resolve the stressed loans above 100 crores. No, stressed loans above 500 crore each in the starting, then 200 crore each, but overall total stressed loan which is need to be resolved or which is need to be overcome with the help of NARCL is 2 lakh crore. So third statement is incorrect, only this part. Rest the entire 2 lakh crore part is correct, but it should be 500 crores, 1, 2 and correct. So answer is going to be A option, will not go with the third option. Got it, guys? Moving on to the next question. Which of the following statement is correct with respect to ARC? It is regulated under SARFAESI Act. That is true. It is regulated by RBI. That is also true. ARC can take over only secured debt which have been classified as NP. Obviously, why you will take over unsecured loan? Because in case of unsecured loan, how you are going to recover your loan amount? It is not possible because no collateral has been given. So if the collateral is given, then only the recovery can be done. That is true. It is specialized financial institution that buys NPAs from banks and financial institutions so that they can clean up. That is also true. So basically, what is the role of ARC? Sir, they purchase the NPAs from the banks, and banks, they can clean up their balance sheet. And now as an ARC, they will be following the process of recovery and they recover the funds in the near future. So answer is going to be A, B, C, E option is correct. That is true. Moving to the next question. Which of the following is the mandatory action? We know this very well. Under PCA, once an organization has triggered the risk threshold conditions, maybe 1, 2 or 3, there are some mandatory restrictions which are included, and there are some discretionary restrictions which are included. If I talk about risk threshold 1, mandatory restriction on the dividend distribution or remittance of profit, this is true. Restriction on branch expansion, so this is related to risk threshold 2. This is the mandatory condition in case of risk threshold 2. Restriction or reduction in variable operating cost and checking out the capital expenditure, that will be under risk threshold 3. So answer is going to be only A. So A option is the correct answer. Got it, guys? Along with this, they also say that the shareholders, they should infuse capital into the company, so that companies' capital adequacy ratios are up to the mark and company can come out of the PCA wala category if it is because of the capital adequacy ratio or unfulfillment of the capital adequacy ratio. Moving on to the next question. Which of the following is the mandatory condition if risk threshold 3 is applied? Restriction on dividend distribution or remittance profit, promoter shareholder to infuse equity, these are both under risk threshold 1. Restriction on branch expansion, this is risk threshold 2. This is the answer. Restriction on variable operating cost, this is risk threshold 3. So answer is going to be C option. That is correct. Moving on to the next question. Which of the following Yes, this I was talking about discretionary restriction. Which of the following is a discretionary restriction which can be placed when PCA framework is invoked? So if a company is under PCA, there are some discretionary, I would say, restrictions which can be introduced. The discretionary is restriction on dividend. So this is mandatory. Restriction on branch expansion, again mandatory. Restriction on director compensation, again mandatory. But yes, RBI can curb on your lending and deposit limits. RBI may ask you don't to accept deposits, don't provide loan, you must provide loan only to the prime lenders or only to the prime borrowers, only prime lending should be done. These restrictions can be introduced, but that are discretionary restrictions. These are the mandatory ones. So curb on lending and deposit, A option is correct. Next, Reserve Bank of India has introduced PCA. So PCA has been introduced on commercial banks. In which year? So it was introduced in 2002. Then it was revised in 2017 after almost 15 years. And after this revision, almost 11 public sector banks were included under the category of PCA, which you need to remember. Moving on to the next question. Asset reconstruction companies must have minimum net owned fund of. So I have n number of times discussed with you what is net owned fund. May I have an answer in the comment section how we define net owned fund? Can anyone give me the answer? I'm going through with your comments. I'm checking out your comments. If someone asks you how you define net owned funds, what will be your answer? What will be your answer? Any idea, guys? Anyone? I'm not sure how many of you have read this term earlier, but it is a very important term. See, net owned fund is related to NBFCs, it is related to ARCs, it is related to many of the companies. So net owned fund is the amount as arrived when we minus the amount of investment of companies in terms of its shares of the subsidiaries, companies in the same group and all other NBFCs. Is it the case? No comments? Okay. Net owned fund, if someone asks you this point, it is very important to answer this question. And how you're going to answer this question, remember that net owned fund basically means, I would say in a very nutshell manner, net owned fund is equals to paid up capital plus free reserves plus surplus funds of the company minus intangible assets minus accumulated losses minus deferred revenue expenditure, the expenditure which you are going to make in the near future. So with the help of this formula, you calculate net owned fund. Net owned fund is now 100 crores for ARC, which was earlier 2 crores. Same 2 crore was fixed at the time of setting up of NBFCs as well. Next, which of the following is a part of tier 1 capital? So in case of tier 1 capital, what all areas or what all assets are included? May I have an answer, please? No one is commenting. I don't know why. Either you don't know the answer, but if you know the answer, you must comment so that I can get to know you're understanding the concept or not. So tier 1 capital includes audited revenue reserve, that is true. Unaudited revenue reserve, general loss reserves, no sir. Tangible assets, no sir. So answer is going to be A option. So remember that tier 1 is basically the core capital which observes the losses. It includes what all things? It includes ordinary share capital, equity capital, audited revenue reserve, and intangible asset, not tangible asset. Intangible assets are included under this. NARCL will pay up to -% of the agreed value for the loans in cash. Okay. When NARCL was set up, there was a statement given that NARCL will be purchasing the NPAs from the banks, but it won't be making 100% payment in cash. 15% will be paid in cash and 85% will be paid in the form of government securities, which are going to be encashed after 5 years. So answer is going to be A option, 15% cash, 85% government securities. Last question of the evening. When was ARC Asset Reconstruction Company Limited incorporated in India? So we all know that SARFAESI Act 2002 Section 3 was the act under which ARC was introduced, and later on ARCs were set up in the economy. Obviously, it will be after 2002. So after 2002, we have four options, but what is the correct answer? So the correct answer is was set up in 2002 itself. So the answer is Asset Reconstruction Company Limited, which provides non-performing asset resolution services to banks and financial institutions, was incorporated in 2002 itself. So I hope all the 15 questions which we have discussed were crystal clear, and I'm pretty sure you are attending our session on regular basis. On Thursday, most probably I will be coming up with a marathon session where I will be taking up 2 to 2.5 hours of session, and we'll discuss 100 plus questions based on finance, and we'll practice them, we'll try to understand them, and we'll understand their depth so that you can answer the questions in the examination pretty well. So that will be all, guys. We'll catch you in the next session. Bye bye. Good luck. God bless you all. Bye, guys. Take care.